The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
An extraordinary attack on Fed independence and, well, a rather mundane response by financial markets. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. to talk about a mundane response in markets. Let's take a look at where the S&P 500 stands. Pretty much modestly higher, and this follows declines in 6 of the last 7 sessions. So you're looking at a gain of 0.2%. We are looking at a steeper yield curve. You can see yields at the short end falling, reflecting expectation the Fed will cut rates next month following Powell's comments on Friday, but yields at the long end rising, reflecting that sell-off there. Now currently up 1 basis point for the 30-year to 4.90%. And the dollar is weaker. The U.S. dollar falling against all the G10 currencies.
The market moves may not seem like much, but it's going to be a big topic of conversation today. But let's step back and talk about how we got here, going all the way back to August 15th. That was when President Trump's Housing Finance Agency Director Bill Pulte wrote to the U.S. Attorney General alleging that Fed Governor Lisa Cook, quote, falsified bank documents and property records to acquire more favorable loan terms. That was prior to her becoming Fed governor in 2022. Less than a week after that confidential letter was reported on by Bloomberg, the president called for Cook's resignation, and Pulte, on this very program on August 21st, said Trump could go even further and fire her. About 19 hours ago, Trump said he had determined there was enough cause to fire Cook immediately. That part, cause, is now in debate. And as of today, Cook is still employed by the Fed. Here's what we do know for sure right now. The U.S. Office of Government Ethics shows a financial disclosure form signed by Cook in 2024 that lists 3 mortgages acquired in 2021, 1 for an investment property and 2 others for what she cited as, quote, personal residences. IRS rules for tax purposes prohibit people from claiming 2, quote, primary residences. Cook, in at least 2 separate statements, has denied any wrongdoing, though she didn't offer a detailed explanation as to why her form referenced 2 personal residences. Elliott Stein worked for years as a white-collar criminal attorney and is now a senior litigation analyst for Bloomberg Intelligence. He says that the mere allegations are likely insufficient to meet the 4-cause standard for ousting a Fed governor, though on their face, the claims against Cook look more damaging than the cost overrun ones made against Fed Chair Jay Powell. Elliott Stein joins us right now to talk a little bit more about that. And Elliott, I do want to talk not so much about the veracity of the claims against Lisa Cook, but more about the veracity of whether there is indeed cause for the president to remove her.
Yeah, and that's the main legal issue here, because the Federal Reserve Act says that the president can remove a Federal Reserve Board governor for cause, but the statute doesn't define or specify what cause means. So we have to look to some other statutes for other agencies that say cause generally means some sort of inefficiency, neglect, or malfeasance. The question here is whether the allegations against Fed Governor Lisa Cook, rise to that level. And my feeling is that until you have some sort of investigation by, let's say, the Fed Inspector General or some sort of investigation by the Justice Department that results in charges, it's probably a little premature to say that the allegations alone satisfy the 4-cause standard.
We should mention that the Federal Reserve, according to a statement issued by the central bank, said it will abide by any court decision, as this will likely be resolved legally. And that's kind of where I want to go to next, Elliott, because Lisa Cook's lawyer has made clear that they will file a lawsuit challenging this firing. Tell us a little bit about Abbe Lowell, because he's a high-profile white-collar defense and trial lawyer known as a top scandal specialist. And I bring this up because he has a long history of working both with Democrats and Republicans. He represented both children of Donald Trump and Joe Biden, Ivanka and Jared, and defended Hunter in his gun charges trial. So is that proximity with all the principals, Elliott, going to be a good thing or a bad thing? Will it work for him or against him? And will it work for Lisa Cook or against Lisa Cook?
Well, I think courts will look at the merits of the argument. They won't necessarily look at Abbe Lowell's bipartisan history of representation, although he is a highly respected lawyer, as you've pointed out with his credentials. So courts will take his arguments very seriously. But at the end of the day, they'll look at the actual arguments that he's making and whether those pass muster. It's not a surprise that Lisa Cook is expected to file a lawsuit. That's what we've been expecting since we saw the news last night that she's being fired. And like we said, the main arguments will be whether the president has satisfied the for-cause standard. And then another key issue that is probably going to be the main battle early on is whether she continues to serve on the Federal Reserve Board while the litigation plays out.
And that is a big question mark going forward. Elliott, I do just want to return to those headlines that Scarlett was reading out, some additional headlines coming out of an official statement from the Federal Reserve saying that it reaffirms its commitment to transparency and that the removal protections serve, in their words, as a safeguard, saying that governors may only be removed for cause. And as this goes to the courts, assuming that is where we are going next, Elliott, I am curious just about the state of the Board of Governors overall during this process, whether Lisa Cook is there or still there during this litigation. Do you have any sort of confidence that they will be able to function in a way that is appropriate with their mandate?
Yeah, I think they'll be able to continue to function. She's only one person on the board. The board is comprised of 7 governors, although one of the seats is in flux because Adriana Kugler resigned earlier in August, and the nominee to fill her seat, Stephen Moran, has not been confirmed yet. But I think the bigger picture here is, from President Trump's perspective, this is likely a play to control the Federal Open Markets Committee, the FOMC, because that's really the body that controls interest rates, which President Trump wants lowered. And what's interesting is this coming February, the Federal Reserve Board will have the opportunity to confirm or to bar the reappointment of the regional reserve bank presidents who serve on the FOMC in addition to the Federal Reserve Board governors. And I think that's what President Trump is trying to control, because if he removes Lisa Cook, you sort of have a 3-3 deadlock balance on the Federal Reserve Board. And as a result, you may not see some of these reserve bank presidents reappointed.
Very good points. Elliott, really appreciate your joining us. Elliott Stein is Senior Litigation Analyst at Bloomberg Intelligence.
And we should just point out, too, the president, of course, was speaking at that cabinet meeting just moments ago. He was asked about this and said, quote, he is prepared for a legal fight on this, and said, quote, Fed's Cook seems to have had an infraction.
Yeah, he also said that they'll have a majority shortly on the Fed, presumably with reference to the Fed board. All right, a number of Bloomberg guests have, of course, weighed in on President Trump's move to oust Lisa Cook. Let's take a listen to what they had to say.
This is a real assault on the Federal Reserve's independence. And as we know, central banks' independence is really important for good economic outcomes.
It's very, very threatening to the very independence of the Federal Reserve. And it should cause concerns, I think, among investors and more broadly about that fundamental underpinning of our strong economy.
The markets are not as upset about it as if some other president were doing it. And I think the markets will absorb it. We don't know how this is going to get resolved.
This is nothing more nor less than a banana republic-style power grab of the central bank trying to diminish its independence.
What we are certain of is that we're seeing a fairly unprecedented attempt to influence the Fed, and not just influence the Fed, but really make members of the Board of Governors afraid.
Joining us now to discuss all of this further is Betsy Duke, former Fed governor and former Wells Fargo chair. Betsy, thank you for speaking with us. What is your take on what we're seeing right now?
Well, I think, as all the other speakers that you just played have said, this is a real assault on the independence of the Federal Reserve System, and it's particularly threatening to every member of the FOMC right now. If the president can remove a member of the Board of Governors based on an allegation that's not even been brought forth in the courts, then that really sets up risk for any member of the Board of Governors. And further, with the risk to the Board of Governors, then there is the potential for removal of the presidents by the Board of Governors if they're all if they're all filled with nominees who come from this same approach.
Okay, so it sets a very dangerous precedent, certainly. I also wonder if the president gets his way and does remake the Fed to reflect his priorities, then he gets his rate cut cycle. We know that kind of like the sequence of that. But what else would he get control over? And I bring this up because Joe Weisenthal and Tracy Alloway in their newsletter point out that the Fed also has a massive balance sheet at its disposal that might be useful to a president who is intent on remaking the entire economy, on remaking industry. How are you thinking about that?
Well, so first of all, let me go back to your premise, if he's successful in removing her. I think the big question for markets to consider is whether or not he's going to be successful in removing her in the short term. So I expect this will go to the Supreme Court. And, the question for them is going to be, is there more harm from having her removed while the facts are being argued, or more harm to let her stay there? And I think it's going to come down that she can stay there until the legal processes have played out. And if that's the case, that sort of brings this to a standstill for a fairly long time until the facts start coming out.
And they could
now, to your question,
on balance sheet.
On the balance sheet, yeah. So the Fed has a huge balance. The Fed's balance sheet can be as big as it wants it to be. So it can buy as much government debt as it wants to, and it does that by borrowing from the commercial bank. So, that can go as large as they want. The Fed can lower short-term interest rates, and the way it does it is simply through its ability to buy as much of the government paper as it needs to get rates where it wants them. But those are short-term rates that the Fed can control. The longer-term rates are going to be dependent on how markets perceive the credibility of the Fed, and particularly the credibility in fighting inflation. So there comes a point where your success can actually lead to your downfall there, because the effects on markets and the effects on the economy and the effects on the dollar.
I am curious, though, Betsy, about just the kind of the function of policymaking going forward amidst all this, particularly against the backdrop, not just with Lisa Cook, but obviously the inevitable replacement of Jay Powell at some point, either at the end of his term or before. Is there this possibility, and Elliott raised this idea, that even getting an extra vacancy, at least amongst the governors, basically almost allows a certain block of the rest of the members? And I wasn't quite clear how that worked. And you've been inside that room. Can you explain how, I guess, is it just 3 or is it 4 members who presumably voted in concert would be able to basically blunt any objections from the other members?
So it's not so much that they can blunt the objections. So in any given meeting, there are designated voters, and if the specific voter, say the president is not there, their number 2 can actually cast that vote on behalf of that reserve bank. So the voting on rates is going to take place. What I would question is, so Lisa Cook has to defend this with her own personal resources. And this is going to be a complicated legal battle, and I don't know what her resources are to wage that battle. And so, it's a question of whether she continues or not. Right now, the Fed is facing a close call, I think, in September as to whether or not to lower rates even a quarter point. I think it's a very close call. And for each person weighing that call, how are they weighing it in light of their own personal risk of becoming a target for the same sort of process? And some will react by getting, just very
I think we're having some issues with Betsy Duke's connection there. Of course, Betsy Duke is a former Fed governor. She knows exactly how that institution operates. She was also a chair over at Wells Fargo. As we continue our coverage here, counting you down to the closing bells with, of course, a special focus on the Federal Reserve, its independence, and, of course, the threats to remove one of the Fed governors, Lisa Cook. The market reaction to the president's proclamation late last night that he was firing Lisa Cook, and a lot of the confusion about whether he even had the authority or cause to actually do that, you would think would have caused a much more severe market reaction. You're looking at equities right now holding in the green, and modest moves right now in the Treasury space. Stephanie Larosiliere joins us right now. She's head of North American fixed income business strategy over at Invesco. And Stephanie, I do want to talk about the moves in the bond market right now. Yes, we have a steepening of the yield curve. But when I talk about, 5 basis points lower on a 2-year and 1 or 2 basis points higher on a 30-year, that does not exactly seem like a massive reaction to at least what initially seemed like a massive decision by the president.
Yeah, I think you're completely right there. I think what we're seeing is really the market understanding this administration and how to deal with this administration. And what the last 7 months have taught us is not to be too early in reacting. A lot of things will be said. There will be a lot of, headlines in the news, but not everything is actually going to be implemented as it's being communicated. So we are definitely in a wait and see mode.
When we talk about this wait and see mode and how much of that is tethered to political leanings and how much of that is actually tethered to the economic data and economic conditions. As an investor and as someone who basically has to advise people on what to do next, how much faith do you put that we will stay committed to reading the economic tea leaves, looking at the economic data, and that those decisions about where rates go are based on that primarily?
Well, I think Jay Powell has made it pretty clear that, even with the more dovish comments that he's made recently, that he is still going to be data dependent. I don't think that has changed. What is really clear is the Fed has a tough job, and they've had a tough job from the very beginning. But now with the labor softening that we've seen, it's become clear that they have to pay closer attention to that. So I still think this is all very data dependent. There's going to be headlines, going to be volatility. But as we talk about what I'm speaking to clients about, we're talking about diversifying into non-U.S. The fixed income market is 40% U.S. bonds. 60% of the outstanding market has not been touched. We've been very, very focused on U.S. bonds for the last decade because of the fact that we've seen such strong performance from U.S. fixed income markets. But we still believe that there's tremendous opportunity outside of the U.S., particularly now as we see a divergence in terms of central banks and the different decisions that they're making.
What if you're beholden to own U.S. Treasuries, to owning the U.S. fixed income market? How do you position for or hedge against the idea of a politicized Federal Reserve, even if it's something that will take a while to materialize? As you point out, we're in wait and see mode. That wait and see could last months.
It could last months, and I think right now what you're seeing in the market is exactly what you would expect, right? So the front end has been rallying based on, the fact that we're likely to see some interest rate cuts, and the long end, when we think about 30 years and we think about the long term of what the ramifications could be here, those are much less certain. And one of the things that we also have to pay attention to is that we do set a precedent for other parts of the world in terms of our decision making. So this does definitely have some knock-on effects that we'll be paying close attention to, that our macro analysts will be paying close attention to, but it's really too early at this point, to start to make portfolio decisions based on that.
Fair enough, fair enough. A lot of people I've talked to today keep saying, watch the term premium. That's the extra yield that investors demand to hold longer-term U.S. Treasuries instead of just rolling over short-term Treasuries. And I'm wondering, how high could that term premium go?
At this point, 4.9%. We could see, the 30-year go to about 5%. I still believe we're in a sort of range-bound space at this point, depending on what takes place, depending on what the news cycle is for the next couple of days. I do believe that the market is definitely downplaying a lot of these comments because, again, we don't know what this actually means. Are these criminal charges? Are these actually, talking about for cause for the Fed governor? Is that actually something that the president can do? All of that is still in wait and see mode. So, again, it could go to 5%, but still unclear where we'll go from here.
I do want to ask you, kind of independent of what's going on specifically with the politicking around the Fed, the idea of the steepening of the yield curve, which of course predated some of the drama that we're in now, and to a certain extent, if you look at the charts, certainly on a 5-year, 30-year basis, predated even the inauguration of President Trump. And I am curious as to what actually started to drive that steepening and where you think that will go, taking some of the politics out of the equation.
Well, I think a lot of the steepening, it was really, the fact that we started to see uncertainty in the long term. When it came to the US presidential election, and we predate that going back into COVID, there was just so much uncertainty in terms of where policy would go, where the United States would go in terms of the new administration. And I think that that led to a lot of the steepening that we've seen. We started to see the front end come down a bit. There were all sorts of additional concerns regarding potential recessions. That's now off the table. Interest rates have been extremely high, and now we're starting to see that come down. And we're continuing to see that steepening of the curve, but with the front end coming down as opposed to seeing just continued rising interest rates on the long end.
Stephanie, thank you so much for joining us. Stephanie Larosiliere is head of North America Fixed Income Business Strategy over at Invesco. And as we were just talking about with Stephanie, we've seen this curve steepening, the 2-year, 30-year yield curve, for instance, steepening the most since 2022 as the president, of course, amps up pressure on Lisa Cook, the Federal Reserve governor. So could a substantial shakeup of the Fed's board and Fed independence overall spiral U.S. debt out of control? Let's bring in one of the leading voices on this. He is Ken Rogoff, professor of economics over at Harvard University. And Ken, if we just take a step back, we've seen the bond vigilantes come in and kind of exert their will on the bond market and deliver a message to the president, most notably with the tariff announcements on Liberation Day. Is this current broadside against the Federal Reserve something that will trigger bond vigilantes? It's not right now, but perhaps down the road.
Yeah, I mean, this is one battle in a running war. And I think, as your previous guest said, markets have gotten used to the noise. They don't really know what's going to come next. I think it's worth bearing in mind with Trump that although he talks like a wild man, he often behaves like a pragmatist. And so I think markets, believe if things did seem to be going south, he would cut back his rhetoric and such. That said, longer term, undermining the independence of all the technocratic institutions, whether we're talking about the Bureau of Labor Statistics, the Fed, that is not good for long-term growth. It's not good for stability. And as the Supreme Court recognized, it's particularly bad in the case of the Fed to have this, political attack. And I want to say, I mean, these are just allegations. We don't know what goes on. Trump, compared to what he had with Powell, this has more teeth. It certainly, forget about what a judge says, but the optics of having somebody who's on the Fed board, having said they had 2 primary residences, when they regulate the mortgage market to some extent. And yes, it happened before she became appointed to being governor, but anyone who's gone through that process knows you have to fill out all sorts of papers, sign all sorts of testimony that it never nothing like that happened. So it is very awkward for the Fed this moment. But what's really bad is the look that it's selective prosecution. Yeah. And look, any of us, if the government turns every single piece of their artillery against us, it's going to find something, a parking ticket, something. And so that's what's really ugly about this.
You had mentioned the BLS, and I'm glad you bring that up because economic data has become politicized after the president fired the head of economic statistics at the BLS because of the weak jobs report. How do you think about the quality and quantity of economic data that policymakers and investors turn to for a clean read on the economy?
Well, I think the private sector's filled in a lot, but that data is, selectively available. It's not as good as being publicly available. And economists have been complaining about this for many years, people who do empirical work about the quality of data being worse. And as I'm sure you've covered and many stories have, the BLS, like many other agencies, has had budget cuts, problems with COVID and the pandemic. So it's certainly been harder to know where we are. I don't want to give that as the only excuse why economists have been so wrong again and again about the U.S. economy. And I think, by and large, people have consistently underestimated the strength. But certainly the statistics have not helped. And by the way, we may find out the strength wasn't as strong as we thought it was. For example, just uncovered in the last jobs report.
I am curious about just the interplay between the various agencies. I mean, we talk a lot about Fed independence, but there has been an argument to be made, at least certainly coming out of the White House today, that maybe there should be a little bit, if not cooperation, a little bit more symbiosis between some of the various agencies in how they sort of shepherd the economy. And I am curious if you see any benefit to that or any real pitfalls.
Was it? General proposition, cooperation sounds nice, but I think what's worked so well about Federal Reserve independence is we've managed to keep low and stable inflation. And there have just been so many benefits to that. And it works. It's not just here. It worked everywhere around the world, or at least in most countries. And those countries that have politicized the central bank, that keep firing the central bank governor, that put a lot of hacks and cronies in to run the central bank, they haven't done well. So whatever the theory is of it, and I think I wrote the first paper about that 40 years ago, it works. And so why would you want to undermine it? Trump appointed Powell. I think Trump, one, had it right, that Powell's done a good job. Maybe he just wants his own people. Maybe they'll behave curiously a lot like the people who are there now. Hard to know.
This gets to a question, though, also about the types of people who will end up on the Fed. And this isn't so much just about qualifications, but about the idea of their approach to monetary policy overall. I guess the question is sort of who would actually want that job? And do you think markets would actually be respectful of that person, knowing maybe potentially that they only got that job because they agreed to whatever the president asked for?
Well, you're right. I mean, it's very awkward for whoever particularly becomes Fed chair when you know that they've had to give a litany of, claims to Trump that they'll do whatever he wants, whenever he wants, that just between them, they'll probably have to say things he wants. He wants someone more MAGA. And yet, maybe, he'll end up appointing someone who's a little more independent. I don't know which way it's going to go. But it certainly makes life more difficult for the Fed, for whoever's the next chair.
All right, Ken, appreciate you jumping on for us. Ken Rogoff there over at Harvard University, of course, a former Fed economist and former chief economist over at the IMF. As we continue to march towards the close, stocks in the green across the board here on this day. A mixed bag right now when it comes to the fixed income market. We are going to get back to that, but we're also going to talk about some of the big corporate stories out there here on the day, including a conversation with the head of the CME Group and a partnership with FanDuel. That conversation coming up after the break, right here on The Close on Bloomberg. 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu. And of course, we're keeping an eye on the markets right now. It is the final week of August, typically very quiet, but there's so many headlines swirling around right now that normally would move markets quite a bit, but because of the muted participation is keeping things elevated, at least in equities for now.
And not only move markets, but we thought move them in the other direction. Sure. I mean, when we saw those headlines last night around 8 p.m. New York time, the president saying he was going to fire one of the Fed governors, the knee-jerk reaction you saw in futures was to the downside, but it was not a huge plunge. No. We're talking about fractional losses. We came in today, and this was a market that just decided, at least for right now, there's nothing to worry about. And believe it or not, Scarlett, we're at session highs on the S&P.
Well, I mean, it's going to take a while for anything to materialize when it comes to the president's plans to fire Lisa Cook, and of course Lisa Cook's response, which is they're going to file a lawsuit against the action. So of course it's not going to be immediate, and we'll see how it all plays out, but certainly there's a lot of positioning, at least for some, in the fixed income market.
Yeah, absolutely.
And of course we are also seeing positioning for Lisa Cook's position, her fate on the Federal Reserve Board in the prediction markets as well.
Yeah, what are they saying?
They're fluctuating odds right now.
Yeah,
they're kind of all over the place. I'm not sure volume on that is extremely busy right now.
Yeah.
Maybe it heats up later on.
Yeah, but this has become really hot, this idea that you can just now just sort of place a bet on anything now.
Absolutely.
You know, remember people were betting whether Jay Powell would actually see the end of his term or be booted out earlier. And now I guess it's Lisa Cook's turn to go through that process.
Make her voice heard, right?
Yeah.
All right, well, we're seeing companies pave more and more inroads into the stock market. You have the CME Group now teaming up with FanDuel to offer bets on stocks and commodity markets, as well as economic indicators like GDP or CPI. The CEO of CME Terry Duffy told Bloomberg that the partnership could even extend to the sports prediction market. So we'll see how that goes. Joining us now exclusively to dig deeper into this deal is the current president and CFO of CME Group, Lynn Fitzpatrick. Lynn, thank you so much for joining us today.
Thanks, Scarlett, for having me.
So I want to start off with this idea that there's a blurring of lines between sports betting and, well, betting on markets, financial markets. What kind of demand do you see from FanDuel's audience for financial market products?
So for us, this partnership is really about distribution and distribution to that retail customer base. So if you look at FanDuel with their 12 million active users, they're really looking for additional access to financial market products. So for us, this is really about bringing our benchmark products, whether that's in equities or crypto or oil, and giving the retail customers access to those products in a way that meets them where they are. So these are smaller size contracts, $1 notional, they're simple yes-no contracts. So it's something that we think is going to have a lot of retail demand.
You think it's something that will have a lot of retail demand. And I guess the question is, because it's being offered in partnership with the CME, these are financially regulated products as well. Walk us through how you ensure that's the case.
Yeah, that's correct. So these will be futures and swaps that will fall under the CFTC regulation. You know, I think what is different about these contracts is you are trading with other market participants. You are not trading against CME. We are simply the market venue, just as we are in any other contract that we offer to the market today.
Is this laying the foundation for something more, Lynn?
I think for us, we'll continue to look at the demand that comes from our retail customer base, and we'll work with our partners to determine what sort of contracts that community is interested in. But really for us, this is about distribution and growing our participation in our markets and growing that exposure and understanding of our benchmark products with a broader retail community.
As you entered into this partnership, I mean, and you sort of took a survey, I guess, of kind of what the market is, what the demand would be. What gave you the confidence that this would bring in a meaningful amount of new business, of new customers that would be additive to the bottom line?
So as we think about it, it's really about looking for that trader of tomorrow. So if you think about the retail participants today and these smaller size contracts, they may not be particularly high in terms of volume out of the gate, but what this is really getting understanding and interest in those benchmark products. So as these potential retail customers may become the institutional investors of tomorrow, and we want to make sure that they have understanding of our products and are really starting to trade those today.
I'm glad you bring up the trader of tomorrow. How else do you plan to bring that trader of tomorrow into the CME fold? How else do you see your company monetizing that relationship?
So this retail opportunity has been one that we've been focused on for the last several years. It has been our fastest growing customer segment this year. And I think what we have been doing is not only looking at products that are sized for the retail community, but also follow some of the conventions that maybe retail is more used to. So something like this event-based contracts where they are simple yes-no contracts is something that we think they will be comfortable with and interested in trading. But it's really something that's just an extension of some of the work that we've been doing with our retail partners over the last several years.
All right, Lynn, well, excited to see how this turns out. Hope to have you back soon to talk about that progress. Lynn Fitzpatrick is the president and CFO of CME Group. The share is fractionally higher on the day. Meanwhile, two stocks taking a plunge here as we get closer to the closing bells. Kohl's, ticker KSS, down about 7%. This after the company is said to be seeking more time to pay its vendors amid a turnaround effort. We should point out that this is based on Bloomberg reporting, based on people they have spoken to, and that a spokesperson for the company says that Kohl's regularly reviews our work to ensure we are operating as effectively and efficiently as possible. But the headline here is that they are asking some vendors for more time to settle invoices, according to people with knowledge of the situation that Bloomberg reporters have spoken to. Those shares now down 8%. Meanwhile, Scarlett, United Health shares also plunging as well, although paring some of their losses, down about 2% right now, as that criminal probe into the company's practices is now said to be much broader than just Medicare.
Yeah, absolutely. And again, this is according to Bloomberg reporting. So we are citing people familiar with the matter. The ongoing criminal probe really focused on the Medicare business, but now it's gone beyond that. And we should note that United Health says that it is cooperating with the government and that it has full confidence in its practices. The stock right now down about 1.8%. According to our reporting, this DOJ probe is also scrutinizing Optum RX as well as payments to doctors. So it is certainly broadened.
All right. We are going to keep a close eye on both of these stocks and bring you any updates on both of those developing stories. And we will continue to follow, of course, the biggest story of the day. And that are a lot of questions about Fed independence. Is it a myth or is it a fact? That conversation coming up just in a bit right here on The Close on Bloomberg. Fed independence front and center today as President Trump moves to potentially fire Lisa Cook from the Federal Reserve Board of Governors. Some economists hearkening back to the 1970s when presidential pressure resulted in a sharp uptick in inflation. Our next guest, though, has done extensive work on the subject of central bank independence. He is the author of probably one of the more seminal books on that topic, The Power and Independence of the Federal Reserve. Peter Conti-Brown joins us right now, Associate Professor of Legal Studies and Business Ethics at UPenn's Wharton School. All right, we talk about a book that came out, I don't know, what was it, 9-10 years ago. And probably one of the more illuminating things about it, at least for a layman like me, was the idea that Fed independence, at least as I always thought of it, was maybe not necessarily as ironclad as it's been characterized over the years. And I'm wondering if you could kind of paint a picture for us of what Fed independence was intended to be and what it has ended up being.
The intention is clear and obvious to anyone who's watched market dynamics play out in the United States and places like Turkey, Zimbabwe, Lebanon, elsewhere. And the idea is that we want monetary policy to have some sort of space between the interests of the incumbent president and the interests of macroeconomic stability. And there's a conflict of interest there. In the short run, presidents want to be reelected. They want to see the election of their allies. And the best way to do that is to goose the economy artificially. And the Federal Reserve exists as a bulwark against that temptation to say, you know, monetary policy, setting of the availability of credit and interest rates, should be with an eye toward macroeconomic stability, both price stability and the stability of employment, not whatever might be best in the short term for incumbent politicians. Now, it's very important to understand that that determination was itself the consequence of a democratic action. Congress created the Federal Reserve with that insulation in mind. That's the intent.
Mm-hmm. That is the intent. Where we are today here in 2025, it's not just a question of the independence, but really the overall structure of the Fed. And there's a debate to be had that we're not going to have time for today about how to sort of maybe reshape the Fed in a better way. But one of the, I guess, big grenades, if you will, that was in that book was the idea that maybe potentially the whole structure of the Federal Reserve in its present form is, in your words, quote, unconstitutional. Why?
Right. The question that I had in mind there was the fact that we had Reserve Bank presidents who served on the Federal Open Market Committee making monetary policy without any kind of mechanism of democratic accountability. They aren't appointed by the president. They aren't confirmed by the Senate. And we don't know who they are. We don't know who appoints them, we meaning the citizens of the United States. The constitutional argument I was making in 2016 was about what the Supreme Court regarded as appropriate for control over the levers of federal policy. We put them in the hands of private citizens, these Reserve Bank presidents. And in 2016, I took the view that maybe we shouldn't do that. Now, I want to be clear that that debate, as interesting as it is and remains for me, is separate from what we're seeing right now. What we're seeing right now is a full frontal assault on the legitimacy of central banks, of our central bank, an assault on the independence of the Federal Reserve at the place where it is already politically accountable, and that's at the Board of Governors. The idea that we should have that space, that gap between the Oval Office and monetary policy, I think is one of the great innovations of democratic governance. The question is if we go too far with that, and as you said, that's a debate for another time. Right now, this is a 5-alarm fire. Right now, what we have is President Trump and his advisors declaring that there should be no difference between what is right for Donald Trump, the man, and what monetary policy comes out of the FOMC.
And of course, we know, Professor, that a large number of legal disputes launched by the White House have eventually ended up in front of the Supreme Court. And if this one does as well, what kind of precedent has been set, first, with regard to executive authority, and second, the Federal Reserve as an institution on its own?
I wish I knew. The Supreme Court doesn't quite know. Its single opinion, which obliterated the protections for the administrative state and gave President Trump the carte blanche to fire anyone in the federal government, included a couple of sentences that said, you can fire anyone you want, but not at the Federal Reserve. That Federal Reserve exception wasn't explained. We don't know its contours. And so right now we're faced with a situation where the president has asserted the ability to fire a central banker on the flimsiest of pretenses. And now the question is going to ricochet back to the courts to define the principles that they did not define before. And so it will be a legal question that, like these many other legal questions, will be resolved in the courts.
What will you be watching for, listening for, Peter, as this plays out? I mean, this could be months before we get a resolution.
The most important questions I'm going to be watching are the way that, first of all, markets and market participants react. And I don't just mean in the bond markets, I mean bank CEOs, many of whom have done the admirable thing of saying that Fed independence has served the country well. I'm going to be looking to see if they repeat those views. And then I'm going to be watching for the very quick legal proceedings, which will be injunctions. So Lisa Cook is very likely right now preparing a preliminary injunction to forbid her removal. And district courts and Court of Appeals and maybe even the Supreme Court in rapid fashion will evaluate the injunction. Now, that's not the merits of this dispute, it's the injunction. And we're going to watch to see whether the courts view the likelihood of success on the merits as landing with Lisa Cook or with Donald Trump. Now, as a lawyer, I strongly suspect Lisa Cook is going to win this, but that's what I'm going to be watching for.
All right, Wharton professor and Fed historian Peter Conti-Brown, thank you so much for joining us. And of course, we will be checking in with you as we move forward with this developing story. The president, of course, just addressing his move to oust Fed Governor Lisa Cook in a Q&A at the White House during his cabinet meeting. Let's take a listen to what he said.
Seems to have had an infraction, and she can't have an infraction, especially that infraction, because she's in charge of, if you think about it, mortgages, and we need people that are 100% above board, and it doesn't seem like she was.
And that was the president speaking at the cabinet meeting. Let's get now to our Annmarie Hordern, who asked the president some of the questions about Lisa Cook. She joins us now from the White House. So, Annmarie, one of the questions you posed to the president was about the court, because as we pretty much expect, this will be decided legally by the court, if not the Supreme Court itself. How did you pose a question, and what surprised you about the president's answer?
Yeah, so there was two key questions in there when it comes to Governor Lisa Cook. One was about the fact that her lawyer had put out a statement saying that they're going to challenge this in court, and the president seemed pretty much prepared to fight that. Said, of course, court challenges happen all the time, and you just heard him there talking about what he thinks she did with this allegedly mortgage fraud. He said this is a problem, especially given the fact that she is a governor at the Federal Reserve. Then while we were in there, because this was an incredibly long cabinet meeting, I believe it was the president's longest time being televised with the press in the entire administration, both his first and second term. But there's actually a lot of, it was a very, very long meeting, let's just put it that way. So we got to go through a lot of questions, and the Fed actually came out with a statement while we were all there saying that they are going to abide by the court order. So I asked the president if he as well was going to abide by the court order, and he said, of course he will. He always abides by the courts. So obviously this is the start of a very long legal process between the president of the United States and Governor Cook. And while the president is talking about the Federal Reserve, some other notable things he talked about. He said that they have Steve Myron that's going to be in there, and he weighed whether or not he could actually take on a longer term. Maybe if there is an actual ouster of Governor Cook, her term expires in 2038. And at one point, the president said, yeah, and at some point next year, we're going to have a majority, meaning he would have nominated a majority of people on the board, and can continuously talk about something that he has been doing really since day one, and that's the fact that he wants to see interest rates lowered.
Yeah, we got that. But I am curious, did he say anything, Annmarie, about the actual investigation? Because there's been a lot of talk about these court cases, basically challenging the for cause or not for cause or whatever we're referring to it as. But I'm confused. I missed the whole part where we had an investigation and determined that Lisa Cook somehow violated the law or the rules in some shape or fashion. What did he have to say about that?
You didn't miss it. It didn't happen. She has not been charged. She has not been convicted. What we did hear from a DOJ official last week was a signal that they planned on investigating this. The president said that these allegations were brought to him, and in his letter, he talks about the fact that that is why he thinks he has for cause, which is why a lot of people think Governor Cook is likely going to win this legal argument. And I think if it goes to the Supreme Court, something we really need to remember, back in May, the Supreme Court really gave a shield to the Federal Reserve, talking about how the Federal Reserve is basically inoculated from politics. It said that this is a quasi-private entity. Yeah. Basically, that this is an entity that should not have any pressure from politics. So this is going to be a process of a very long legal proceeding, but a lot of scholars will say at this moment they think potentially this is going to be a win for Governor Cook.
Annmarie Hordern there outside of the White House as we continue to follow the big story of the day. And of course, that is the political pressure on the White House now squarely focused on Fed Governor Lisa Cook. The market, though, Scarlett, kind of taking it in stride a little bit. I think we were expecting more of a negative reaction, but maybe kind of what Annmarie was just talking about, how this could be a long process, and maybe a process that Cook might win. Maybe that's why the market's saying, well, okay, shoulder shrug, whatever.
Right. Well, the market has had a lot of experience having to digest announcements from President Trump and then seeing them kind of play out weeks or months down the road. So right now you have the NASDAQ 100 up 0.4%. And I point this out because we have NVIDIA reporting earnings tomorrow. So that's a catalyst that we're all going to be watching for before people go away for the long weekend. Short-term rates, you can see there, are falling due to rate cut expectations. Jay Powell, not so long ago on Friday, pretty much giving the green light to a rate cut in September. Long-term yields, however, are inching higher as investors price in a loss of central bank independence. And I make it sound really easy, like you can price that in. It's a lot more complicated than that. But you're starting to see worry, or you have been seeing worry at the long end of the yield curve. And that is really, I think, the big story of the day. And we should point out, we were speaking about this a little bit earlier with Stephanie Larosiliere, the idea that that curve has been steepening long before the current drama about the Fed and President Trump, in fact, starting more towards the start of December. Mike Contopoulos joins us right now, Deputy Chief Investment Officer over at Richard Bernstein Advisors. And I do want to start off, Mike, with that steepening of the curve. Kind of what sort of started that steepening and how much, I guess, let's just say, the political issues of late have maybe exacerbated that, if at all?
Hey, Romain, I think it's a couple different things here, right? Because you have obviously two parts of the curve that we're talking about, the front end and the long end. I think what actually started it was nothing that has been mentioned thus far, which is really the deficit. I think that's really what started the steepening. I think that's what will continue to, put a little bit of pressure on the long end of the yield curve. You factor in sort of structural headwinds on inflation, plus a Federal Reserve that, many investors think will start a cutting cycle in September, and I think that's what gets you to where you are today. But I think the deficit is really what kicked off the steepening earlier this year. And it gets to the question, though, as to what, if at all, the Fed could actually do to sort of maybe right things. And I mean, I'm assuming they would even want to right things, but let's just assume that for a second. What can they do to maybe blunt the impact of some of the fiscal decisions that have been made as of late? I think the Fed is a little bit hamstrung from that, right? As we all know from Chair Powell and years and years and years and decades of watching the Fed. I mean, they don't really have a hand in fiscal policy, and nor do they react to it. I truly do believe that the Fed, as an independent entity, really is there for their dual mandate of inflation and employment. And I think whatever the fiscal side of the ledger is doing, they're going to have to react to in terms of how that manifests itself in the data, but that's about it. So I don't think they're actually too worried per se, but I do think it makes their job quite a bit harder. And they're caught a little bit between a rock and a hard place because of that. But I don't think they plan for it. I think they're quite reactionary, whether, fortunately or unfortunately.
I was just looking at the chart of the 30-year yield. It's been in a range for the past 3 months. They're rising today, as we know, but it has a ways to go before it tops 5%, which was the highest since summer of 2007, and which it topped in mid-July. What breaks the 30-year yield out of this range to go above 5% again?
Yeah, I think it's there's a couple of different things. I think first and foremost, it's stronger inflation, which I think everybody should be expecting at this point. The markets want to have their cake and eat it too. They think you're going to have somewhat benign inflation or maybe even lower inflation from here. They think, corporate margins are going to stay healthy and earnings growth is going to stay strong. And the fact of the matter is tariffs are a tax and someone's got to eat that tax. Mm-hmm. And right now, I think it's going to be a little bit on the corporate side and also a little bit on the consumer side, the sort of the end customer. And so I think inflation is going to, be sticky around 3%, maybe even start to trend higher. We're talking about core PCE here, which of course is the Fed's preferred gauge. And I think that could easily take the long end of the yield curve up towards 5 or even above 5 again. Should growth surprise to the upside? I mean, that'll do it as well. Mm-hmm. I think if the Fed cuts in September and you get a strong inflation print, you will see higher long-term yields, very similar to last September when the Fed cut 50 basis points and the 10-year went up 100 basis points subsequently. So kind of a little bit maybe counterintuitive for some of the administration who want to see lower rates to help the mortgage market. Yeah. The Fed controls the front end, not the back end, and it could be counterproductive on the back end to cut rates in September. Right.
Be careful of what you wish for. So at what point, Mike, do rising bond yields, if let's just say the 30-year gets above that 5% level, when does that put pressure on stocks? Because you look at the equity market right now, it's kind of shrugging things off.
Yeah, I think it doesn't take much more than getting above 5%. I think almost more importantly, and Scott, you wouldn't hear me say this in most circumstances because I think the Fed is a little bit of a sideshow. The market prices well before the Fed. Yep. But this go-around, I think actually the Fed meeting does matter in September because of the expectations built around cuts. If the Fed doesn't cut in September, I think you could see a real pullback in markets. And if the Fed, just because of the surprise and the shock that will provide, particularly to momentum trades, and if they do cut in September, and over the next 1 to 2 months, the 30-year to 20-year all go north of 5%, I think it hurts markets as well. So it's sort of like a damned if you do, damned if you don't from a market's perspective. But I think anything above 5, and you start to get that momentum trade, maybe start to fade a bit.
All right, Mike Contopoulos, Deputy Chief Investment Officer over at Richard Bernstein Advisors, helping us count you down to the closing bells. The 30-year yield camped down around 4.9%, and your 10-year yield at 4.25. Your 2-year yield at 3.7. And Scarlett, we talk about equity market in the green once again, and that's led higher by, of course, some of the tried and true names, including the NVIDIAs and Teslas.
And of course, NVIDIA will be reporting results tomorrow as well. I wonder how high the bar is right now, given what it's been doing and the comments that we've heard from the other big tech companies during the earnings season. It feels like months ago now. Yeah, the bar is high, and I think we came into this week expecting that to be the big news event. It got a little overtaken by some of the stuff today, but of course, starting tomorrow, all eyes will be back on NVIDIA. Right now, all eyes on this financial market with a full breakdown of all of today's market action coming up in our global simulcast now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick here with Scarlett Fu, taking you through to that closing bell with the global simulcast. It starts now. Tim Stenovec in the radio booth, Isabel Lee by his side. Carol Masser has the day off. Welcome to our audiences across all of our Bloomberg platforms, including our partnership here on YouTube, as we focus in on the biggest story of the day, Tim Stenovec, and of course, that is the nuptials between Travis Kelce and Taylor Swift.
I knew you were going to say that. There's always a Bloomberg angle to a story like that.
Oh, yeah, we will have it.
Yeah, we have it. Yeah. Taylor Swift turns her engagement into another media coup, written by none other than one of our media reporters, Hannah Miller. It's all about how they did it on Instagram, and that's where they go. That's my coverage. That's the extent of my coverage, Isabel.
That's what you've been focused on.
Of the story. I know you're all over it.
I think another business angle could be the size of the ring, and whether it's lab-grown or whether it's a natural diamond. That definitely is of interest to the viewers and to my friend group. My group chats are all lighting up.
I feel like we're going to get an answer to that sooner than an answer to what happens at the Federal Reserve with Lisa Cook, her fate, especially as her lawyer plans to challenge the firing by President Trump.
Yeah, and thanks for bringing this back, Scarlet Fu, because we talk about a market that, I think we came in today expecting more of a sell-off in equity markets and, of course, a lot more ructions in the bond market. We did not quite get that. You did see a steepening of the yield curve, of course, with the yields on the shorter end of the curve moving lower, longer than the curve moving higher. And as far as stocks go right now, guys, right around session highs.
Is the market essentially saying we're not buying into this notion that the Fed independence is threatened, Romaine?
I would think that they're maybe buying not so much into the idea of independence, but they're buying into the idea that one way or the other, not a whole lot is going to change at the Fed. The idea that they are expecting rate cuts, they think they're going to start in September, and at least based on what we know now, Lisa Cook's not going anywhere, so maybe it is just the status quo. The S&P 500 moving higher by about 27 points on the day, closing up 0.4%. The Dow Jones Industrial Average up 0.3%. The NASDAQ indices, both the composite and the 100, each up about 0.4%. And your outperformer on the day, that will be the Russell 2000, 19 points higher, or 0.8%.
In the S&P 500, pretty much an even split of stocks that moved higher and lower, with a slight higher number going to stocks that moved higher. 258 to the upside today in the S&P 500, Scarlett, 243 to the downside.
All right, let's take a look at the IMAP as well, and you'll see a pretty big mix of sector performances. What's notable, of course, is that the bigger sectors are in the green, led by industrials, financials, and healthcare. Industrials, the only group gaining more than 1%. On the downside, you do see some red slices there. Consumer staples losing 0.5%, REITs losing about 1/3%, and communication services just marginally lower right now.
All right, I want to talk about one of the most actively traded stocks. And it's going to have to wait because we got some earnings coming out, Romaine.
Yeah, Okta, the software company, reporting earnings right now. The knee-jerk reaction, the shares to the upside by about 6%. A beat on the bottom line. 2Q EPS, 91 cents a share. The street was looking for 84 cents. Revenue in the quarter coming in at $728 million. The street was looking for roughly about 697. And here's your guidance for the current quarter, the third quarter. The company says it sees revenue in the range of 728 to 730 million. The low end of that range above the average of analyst estimates. EPS, a range of 74 to 75 cents. The street was looking for 75 cents on average. And for the full year, the company guiding for EPS of $3.33 to $3.38. And that does appear to be a bump higher from its previous guidance. So basically a beat and a raise here.
A beat and raise, and also margins are also expanding, at least adjusted operating margin, 28% versus 23% a year ago. And within the businesses, Tim, I'm looking at professional services, which is the smaller part of its business, up 21% year over year, coming in at $17 million. The subscription revenue business, which of course is more consistent because it's recurring revenue, $711 million. That is up 13% year over year, also better than anticipated.
And we should point out, while this is a relatively small company, $16 billion market cap, there's a lot of focus on it ahead of NVIDIA, which reports about 24 hours from now. Of course, Okta with a big presence, or at least trying to have a big presence in the AI space, and a lot of concerns and questions, Isabel and Tim, about exactly whether that spend is going to continue at its current pace.
Okta shares moving between gains and losses, up about 1.1% in the after hours right now. We will be glued to NVIDIA tomorrow and our special coverage, too, on Bloomberg Television and radio. Back to some of the big movers in today's session. I want to start with EchoStar. A share surged to a record, most ever at one point in the day. Ended up closing out the day up 70% today. This, as the company said it's agreed to sell spectrum licenses to AT&T for about $23 billion in an all-cash transaction. AT&T said the acquisition of this spectrum will strengthen the company's ability to deliver 5G and fiber services across the U.S. EchoStar, for its part, will continue to operate in the U.S. market as a hybrid mobile network operator under its Boost brand. Also, keep an eye on what happened with shares of Lilly today, to the upside of 5.9%. This after news that its experimental obesity pill helped patients lose 9.6% of body weight in a trial. So instead of a shot, yes, it could be available in a pill at some point in the future. Patients who were given the highest dose of the pill lost around 21 pounds and saw significant improvements in blood sugar levels, according to the company. Shares higher today by close to 6%. And finally, keep an eye on stocks in the defense sector today, particularly Lockheed Martin, which moved to the upside about 1.7%. This after Commerce Secretary Howard Lutnick suggested earlier on CNBC that the U.S. government is looking at the defense sector for potential stakes in companies a la Intel. The secretary did signal out Lockheed Martin, saying the company makes much of its revenue because of the U.S. government and is, quote, basically an arm of the U.S. government.
Let's now look at decliners. Constellation Brands, we have the shares down by nearly 4%. That's after Bank of America downgraded the company to underperform on weaker beer trends. So more noteworthy is the fact that the bank holds the only sell equivalent rating. So they cut their price target to a street low of $150. That's from $182. So the stock saw pressure and is down by 3.5%. Up next is Keurig Dr. Pepper. Shares are also down by 6.5%. That's after HSBC downgraded the stock to a hold from buy. This comes after the JDE Peat purchase announcement on Monday. So the price target is cut to $30 from $42. The analyst there said that the unwind of the 2018 Keurig and Dr. Pepper merger comes at a, quote, high acquisition cost. And lastly, we're looking at Salesforce. It's also down by 1.5%. Oppenheimer cuts its price target to $315.
All right, let's just jump here on earnings. We have earnings from MongoDB, and I'm going to pull them up right now. We do see for the second quarter, this is the quarter that ended, the loss per share was 58 cents, which was smaller, more narrow than what analysts had versus last year, I should say, which was 74 cents a share. Adjusted EPS was $1 versus the consensus estimate of 65 cents. In terms of the revenue, it's $591.4 million. Analysts were looking for $554. The outlook for the full year, $2.34 billion to $2.36 billion. That is an upgrade from the previous forecast, which was at least $2.25 billion to $2.29 billion. Full year adjusted EPS, according to MongoDB, also goes to $3.64 from $3.73. That is a notable upgrade from the previous estimate of at most $3.12. And you could see the stock responding here, up 12.5% right now in after-hours trade.
Kind of interesting to see some of these mid and smaller software companies getting a bid here in the after-hours trade. A lot of concerns, of course, heading into those earnings out of NVIDIA tomorrow. The idea that some of the spending that had been flowing into some of these identity security companies, some of the cloud providers like Box and, of course, MongoDB, that we would see some weakness there. But the earnings coming in right now, and at least for the current quarter and the guidance for the next quarter, seems to be holding up on MongoDB. Box also reporting a beat and a raise there here on a day where there is a big focus right now on corporate fundamentals with NVIDIA up ahead in about 24 hours. But, of course, right now, everybody obsessing over the Fed and what may come next. We saw the steepening of the curve today. A lot of concerns here that, yeah, we may end up with a dovish Fed no matter how much this shakes out. But, of course, this also could be a Fed potentially that could end up maybe not being as prepared to fight inflation longer term. And that's a big part of the reason why you're looking at the long end of the curve moving in the opposite direction.
You know, one thing that Tim pointed out that I thought was really interesting was Lockheed Martin and defense companies rising after Howard Lutnick, the U.S. Commerce Secretary, suggested that the government is looking at the defense sector for potential stakes in companies. What I'm not clear on is why this is seen as a good thing for the company, why the defense shares would be rallying, because it's not just Lockheed Martin. We also saw RTX and General Dynamics gain ground as well.
Well, there are a lot more questions than there are answers at this point. I think maybe there's expectations, or at least in some cases wagering, that there could be some support from the U.S. government for some of these companies. After all, in some of these cases, the U.S. government is the biggest customer of these companies. But I think it opens up a bigger question about the role of the United States and the role of government in private corporation. And I think that if you were to look at a traditional Republican view of free enterprise, it would not include a 10% stake in Intel, for example, or it would not include funds going to a miner like MP Materials. But the president and his cabinet have really made clear this is a new era when it comes to the corporate world.
Also, it raises the question, would partial government ownership really strengthen national security planning or risk distorting market competition and pricing in the sector? And we were talking about this earlier, Tim. What influence would the government gain on company strategy and really just management decision-making if they take a significant stake in companies like Lockheed Martin or Intel?
All right. Well, as I mentioned, still more questions than answers for the latest. Always check out the Bloomberg terminal, of course, and Bloomberg.com as well. That is going to do it for our cross-platform coverage of the close this afternoon. Do not worry. We will be back tomorrow, same time, same place for those NVIDIA earnings.
A lot more coming up here on Bloomberg Television. Stick with us, a jam-packed hour as we continue to parse some of the moves in the fixed income space. This is The Close on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
Welcome back to The Close. Markets closing out the day just about 11 minutes ago, higher. That might have been a little bit of a surprise to some folks given some of the political news across the wire just yesterday evening. But the S&P did manage to add about 0.4%. And a big part of that is the fact that corporate fundamentals are still holding up. We are getting earnings crossing the wire earlier today out of names like Okta and MongoDB, beating estimates in the most recent quarter and rating guidance going forward. We are waiting to hear from PVH Corp, of course, a big apparel maker, sometime this afternoon. And of course, tomorrow afternoon, the granddaddy of them all, the biggest weighting in the S&P and the NASDAQ, the largest company in public markets, NVIDIA, gaining about 1% on the day. Meanwhile, when it comes to what some of those political issues, you did see a lot of movement in some of the more rate-sensitive areas of this market. The KBW Bank Index rising about 1.3% on the day, now back to a 3-year high. And of course, we're going to talk a lot about the moves that we saw in yields, of course, opposite directions, depending on what side of the curve that you sit on. And that brings us to our top story here, the remaking of the Federal Reserve Board of Governors into, well, a monetary policy institution that could potentially be more accommodative to a White House looking to goose economic growth and blunt the impact of its own fiscal policies. The mysterious resignation of Fed Governor Adriana Kugler just a couple of weeks ago. Then you have the potential departure of Governor Lisa Cook swirling around today, and Trump's investigation over the past few weeks into renovations at the Fed's headquarters. All of this raising hackles about a coordinated effort to create Fed vacancies to be filled with people more loyal to the president. Concerns about the integrity of the Fed independence abound. J.P. Morgan's Mike Ferroli saying if the president, were successful in removing Cook, the outcome would be momentous. If the two most recent dissenters allied with whoever fills the two new vacancies, they could remove all 12 presidents, thereby dramatically reshaping the FOMC. While equity investors seem to be somewhat comfortable with that scenario, the bond market is a bit more divided. Short-term rates sliding on the potential for a more dovish Fed. Long-term rates rising because of the idea of an ultra-dovish Fed, and one that might be ill-willing and maybe even ill-equipped to keep a lid on inflation, which would, of course, make bonds worth less over time. This so-called steepening of the yield curve, when measured by the gap between the 5- and 30-year U.S. yields, that's now the most slanted since September 2021. Anish Shah joins us right now, global head of debt capital markets over at Morgan Stanley. And Anish, I do want to talk about this steepening of the yield curve. This isn't something that began today or even last month or the month before. It's been going on now since at least maybe November, December of last year. And I am curious what you think has been driving that steepening and whether you think that steepening will continue.
Well, Romain, it's great to be with you. Thanks for the opportunity. You know, clearly no shortage of activity in the capital markets this summer, no summer slowdown. We've been really busy with our clients talking about the rate outlook and the picture going forward. And really what it's done is our clients have been focused on accelerating refinancing. If you look at the volumes we've seen in investment grade and leveraged finance markets, it's all been about getting ahead of potential volatility down the line. I'll give you an example. In the summer, we had one of the most active markets in the leveraged finance markets that we've seen. Mm-hmm. July was a record month in terms of leveraged loan issuance. But it was all around repricing. So it was issuers going out, taking existing loans and trying to cut the spread on the loans. What we haven't seen is actually a wave of new issuance, new event-driven issuance. That's really what the markets have been looking for.
On the refinancing side, what do those durations look like? And do you think that they would have been different if sort of some things hadn't happened over the last few months?
Yeah, it's a great point because in the investment grade market, there's been very little in the way of 30-year issuance. It speaks to the steepening of the yield curve that you talked about. Almost all the issuance we've seen this year has been 10 years in, but we have seen issuers trying to get ahead of maturities, 2026, 2027 maturities, and try to de-risk as much as they can. We are just starting to see, though, in terms of deal flow and activity, that pipeline shift from refinancing to more event-driven activity.
What is holding back new issuance?
It has been a lack of events, frankly. You know, investors, investors came into the year really optimistic about what they would see in terms of M&A deal flow and buyout activity. And as you know, due to the tariff announcements in April, we saw a real pause in that. As a result, we were seeing investors really building cash because they were looking for opportunities to invest new capital, and we weren't seeing the level of buyout activity that we would expect. Now we're just starting to see this really turn in terms of the dynamic around our pipelines. Yesterday, you saw a big announcement in the corporate space, Keurig Dr. Pepper acquiring JDE Peet's. This is a large cash cross-border acquisition. That's the type of activity that credit investors are looking for. It's going to be financed with a $19 billion bridge loan, the largest bridge that's been underwritten in a year. And that's the type of activity that I think we're going to see a lot more of post-Labor Day.
So you think we'll see more of that? So you think the appetite for that will be there? And more importantly, the sort of economic and political conditions will be supportive of that?
Yeah, I think what we're hearing from our clients is, notwithstanding today's news events, is much more comfort with the impact of tariffs. Our clients are able to now model the impact of tariffs and think about different scenarios, whereas 6 months ago that just wasn't even possible. And now we're starting to see a meeting of the minds between buyers and sellers. We're seeing more private equity activity. I'm optimistic we're going to see a lot more M&A-driven deal flow post-Labor Day.
I am curious when we talk about more deal flow activity, and it's curious you bring up the Peet's, KDP Peet's thing. Do you think that will be a lot of cross-border activity? Because there has been concern politically that maybe cross-border deals, particularly between the U.S. and certain countries, would not be approved. Or do you think we'll see more domestic type of deals?
I think most of our activities actually have been more focused on domestic. This is probably a rare example where the industrial logic really makes a lot of sense for these companies to combine. But you're seeing much larger transactions. You know, we saw the Baker Hughes Chart Industries deal in the oil services sector. That's a domestic transaction. Obviously, the big deal in the rail space that we worked on. So there's a lot more of that activity. I actually think the capital markets are a real catalyst for this, meaning the availability of financing in size with certainty is going to be helpful to the dynamics of bringing the buyers and sellers together.
I am curious, though, for the investors that would have to take on, or I guess maybe take on the risk with regards to some of these new debt issuances that come out. Do you think they're actually getting a proper risk premium into it? There's been a lot of talk about how tight credit spreads are. There's a lot of talk about the differential between what we're seeing in the Treasury market versus in equity markets, and the idea that that gap is so narrow right now that maybe there isn't as much incentive to swallow any large-scale new issuance.
Well, credit fundamentals are sound. If you look at the way corporate balance sheets have been managed the last few years coming out of COVID, they've really been built to withstand the higher level of rates. You haven't seen that aggressive action maybe that would run counter to creditors' interests, like levered buybacks. So for the most part, balance sheets have been managed very, very prudently, and leverage has been kept low. And that I think is also driving the spreads as tight as they are, is that you have this supply-demand imbalance and credit fundamentals very sound.
Last question. Do you think 2026 is going to be a better year for this market than what we've seen so far in 2025?
We're optimistic. Our clients are very optimistic about the future here, and there's a lot more strategic activity than we saw a year ago, for sure.
All right, really smart. Great to have you here in studio, too. Anish Shah is Global Head of Debt Capital Markets at Morgan Stanley. We're going to get back to the conversation about what's going on in the fixed income markets, but we are getting earnings out of PVH Corp, the owner of Tommy Hilfiger and Calvin Klein. Reporting revenue in the most recent quarter that came in relatively in line with estimates, $2.17 billion. Adjusted EPS beating by a big margin, $2.52. The street was looking for $2. And here's your forecast going forward. The company says that 3Q adjusted EPS will come in below the average of estimates, $2.35 to $2.50. The street was looking for $2.94. The company blames tariff impact. We'll be back in a moment. This is Bloomberg. All right, let's get a read on C-suite sentiment, because executives out there do seem to be scaling the market's wall of worry. Of the S&P 500 companies that changed their revenue outlooks this earnings season, 44% raised the biggest chunk of the index that has done so since 2021. Our next guest points out that volatility isn't always negative, at least when it comes to corporate leadership. David Garfield is the co-CEO over at AlixPartners, and he joins us right now. And David, our previous guest was kind of alluding, at least from a market perspective, to this idea that why there was so much pessimism earlier this year was kind of because of the uncertainty, the idea that nobody knew what the tariffs would be. They didn't know where we were going. And now that we have a little bit more clarity, people are kind of coming back out into the sun. That's the market narrative. I am curious as to what you're hearing from the corporate side, from the C-suite, as to whether now there is a little bit more renewed optimism since there is maybe a little bit more clarity about what's coming.
I would say that there's a great deal of pragmatism coming out of the C-suite at the moment. There's still a lot of uncertainty. There's still evolution in tariff and trade policy. There's still gyrations in market valuations. But what CEOs have clearly determined is that they still need to make decisions, take actions, and place bets. And so after some initial pauses in projects and proposals, they're moving forward and they have more confidence as a result.
One of the big concerns coming into this year with a lot of these companies was how quickly they would be able to adapt, not just to tariffs, but so many changes to our economy based on policies coming out of Washington. And I am curious as to how you gauge the effectiveness of companies, of those CEOs, being able to kind of turn their ships, if you will, around depending on what's coming out down the pipe.
A key thing is for CEOs to move forward even in the face of uncertainty and against some of the headwinds. And there are some things that are no regret moves, even when there is questions about how your market conditions are going to evolve. Things like stress testing your balance sheet and your cash flow so that you have the flexibility and the resiliency to deal with more volatility if it comes your way. Doubling down on your customers, because deepening relationships with customers helps you defend as well as capture market share. And then just communicating internally, making sure that your employees actually understand why there's volatility in the marketplace and what the new or renewed priorities are for the enterprise.
I am curious about what's going on the companies that have more direct exposure to tariffs. Today, we were talking about PVH, which just reported earnings, a big apparel maker. This whole week, we're getting a lot of earnings out of the apparel makers. So we're hearing a lot about tariffs. It's not necessarily as dour as what we saw. Yeah, there are increased costs. Some companies eating those costs, some finding a way to nudge some of those costs onto the consumer. As we get deeper into this year and next, when the tariff impact will be maybe a little bit more preeminent, do you think companies will be able to have that pricing power to go to their customers and say, we have no choice to bump prices higher?
A couple of things are going on. First of all, it is the big dilemma for tariff impacted businesses trying to decide how much of that tariff impact to absorb and how much to pass through is a really critical decision, which is why we're spending a lot of time talking to senior executives about their pricing strategies, making sure that they have the accuracy and the speed in their pricing processes to execute the right decisions. But as time progresses and the impact of tariffs mount, one of the key things that executives have to contend with is not just the short-term objective of defending their margins, but the long-term objective of attracting and retaining customers. So what we're advising clients is balance the short-term imperatives around margin with the long-term customer strategies and support your brand.
I am curious with regards to raising prices, what your general advice would be on the transparency in that. I mean, some companies have been pretty explicit. We're doing this because of tariffs. Others have just kind of maybe snuck the price increases in there and didn't really make much of a to-do about it, if you will.
Right. Our advice is communicate with clarity and context. What we mean by that is we do advocate transparency, but make clear that to your customers and to the end consumers that your pricing is not just about your input costs. It's about the value that your products and services deliver and your brand positioning. If customers and consumers understand the full picture, they're more likely to accept your pricing decisions.
Yeah. All right, David, great stuff. David Garfield there. He is the co-CEO of AlixPartners. A closer look at some of the advice being given to the C-suite. When we come back, we're going to go back to the big story of the day, the pressure, the political pressure on Fed Governor Lisa Cook, a conversation with House Financial Services Committee Ranking Member Maxine Waters.
the Fed will abide by any court decision.
Thank you very much.
Will you
Ariana.
abide by a court decision?
I abide by the court, yeah. I abide by.
President Donald Trump there today in the last hour, responding to our very own Annmarie Hordern, asking a question if he'd abide by the court in deciding the outcome of what's going on right now with Fed Governor Lisa Cook. Allegations we should say, allegations that have yet to be investigated or founded, but allegations that the president and his allies have made that she may be potentially committed mortgage fraud. Joining us right now is Maxine Waters, the Democrat representing the great state of California and the ranking member of the House Financial Services Committee, which has oversight of the Federal Reserve. And Representative Waters, I do want to get your thoughts here, not so much on whether the allegations are true or not, but whether you were informed at all at any point in this process that the White House was looking into what Lisa Cook put on her financial disclosure forms.
Well, first of all, let me just say that the president is out to exercise power. He wants to take over the Fed. He's tried to intimidate Powell. And so what he's doing is he's eliminating one of the board of governors, happened to be a black woman, Lisa Cook, so that he can have control of the Fed and the decisions that they make. The Fed is extraordinarily important. How it is instituted and arranged by the Constitution of the United States of America. We have tremendous analysis and work and research that goes into the decisions that are made. He hates Powell. He wants to be in control. He wants to determine whether or not we raise or lower interest rates. He wants interest rates lowered now. He doesn't know what the hell that he's doing. He's talking about paying down the debt with money from lowering the interest rate. All he's going to do is increase inflation. And we have had enough of inflation that caused the groceries to go up and our cost of living to be extraordinary. He claimed when he ran that he was going to bring down the cost of groceries. Right. He's a liar. He does not respect the Constitution, and he wants to control the Fed. What a terrible thing that would be.
I am curious, though, with regards to the issue of trying to control the Fed. There is a process potentially that will play out, at least with regards to Lisa Cook, a legal process. Right now, we've only heard from her attorney. The Fed has also issued a statement saying that it will defend itself on the issue of Fed independence, not necessarily Cook herself. I am curious as to whether you or any of the other Democrats in Congress have talked about supporting Lisa Cook's effort to defend herself in court.
Well, I was one of the ones that supported her when she was nominated. I wrote a letter of support, as others did. I support her. Yes, Democrats are going to support her. And we know that basically the Constitution says for a cause. I don't accept that this investigation that he's doing of black people and black women and all of that is for a cause. And so, yes, I think they should go right into the courts with a lawsuit. I support that. I'm going to try and get an amicus brief filed in support of that, because I think the president is ruthless and he is disrespectful of the Constitution, and he wants to run America like a dictator. We cannot stand for that. I'm proud of her. She said, I'm not resigning. I'm not going to step down. That's the kind of fight that we need to have with him.
I am curious, and I ask you again, whether the White House has made any effort to reach out to the committee, whether you or the actual Republican committee chair, with regards to what they're looking into with Lisa Cook and really with the Fed writ large.
They have made no effort on the Democratic side. I can't, answer for, Congressman Hill and others on the, other side of our committee, the Financial Services Committee. But no, he does not reach out to us. There's no negotiation going on, and all of the changes that we see take place, these are moves by the president who have been well planned in advance with the group that's working with him, looking at all aspects of government in order to take it over. Can you imagine the president of the United States interfering with our educational institutions, private law firms, nonprofit corporations, on and on and on? It is something that is absolutely unbelievable.
Well, it's believable because it's happening, Maxine. And I guess my question is is there, not so much is there a justification for what he's doing, but if the Republican, his party, has decided that they are on board with this, and of course right now they control both houses of Congress, they control the courts, they control the governorships, and they control the White House. What pushback, if at all, do you and your fellow Democrats have, if any?
Well, let me just tell you this. As you have watched the decisions that have been made by the Republicans, they follow whatever Trump wants them to do. Whether or not they believe in it, are they afraid of him? Yes, they are in control. Our job is to take back the government. Our job is to take back the vote in the primary, and that's why we're dealing with all of this redistricting effort that we're involved in. Our job is to get rid of the president of the United States that exists now and the next election, and try to elect people who really want to represent all of the people and respect the Constitution and the democracy.
How are you doing that? I mean, the Democratic Committee is starting their retreat, their annual retreat that they have to kind of talk and strategize about what they're going to do in the midterm elections. Everything you said you want to do, at least legally, you have to do that through an electoral process. Where exactly do you guys stand when it comes to some sort of cohesive argument against the policies, the positions, and the practices of this administration?
Well, let me just say this. I am convinced and I believe that there are many who voted for him who are having buyer's remorse. For example, in Medicaid, there are a lot of people. They're not just black. They're not just urban. These are in poor areas where hospitals are going to close down. They didn't know that this was going to happen to them. When he talks about getting rid of lowering the ability for people to have access to food stamps, a lot of people didn't know that many of our students who survive on food stamps and our elderly are going to be cut off. A lot of this, I do believe that people are going to reject in terms of whether or not the president is respecting the democracy and the work that has gone on for years by so many in order to have a country where we give people and assist people in a decent quality of life. And it's not just for one sector of our society. This is for everybody. So we believe that he's making a lot of mistakes that's going to hurt him. We're going to register people to vote. Yeah. We're going to raise a lot of money. We're going to hit the streets. We're going to be rallying, and we're going to make sure the people know that he is friends to Epstein and that was his best friend. He knew that he was a pedophile and messing around with young girls. We're going to put that argument out there and join with some of the Republicans who are already saying they want to know who was involved. And this president is doing everything that he can to hide, to avoid, giving the information about his friend, the pedophile, who was his best friend. We're going to put that on the agenda also so that we keep it in front of the American people, and they will be disgusted with him. We think we can win on these issues. We think we can have the money that is needed. We're going to run strong campaigns.
All right, Representative Waters, we have to leave it there. Maxine Waters there. She is the ranking member of the House Financial Services Committee, a Democrat from California. We will continue to follow this story with regards to what has been going on with Lisa Cook, the political pressure on the Fed, and really a lot of discord right now in Congress over the direction that the president has been taking it, of course, at the behest and with the support of his party, was elected to office last November. We do want to turn back to the markets. We had a market today that did, for just a very brief moment, seem a little bit rattled by some of what was going on in Washington. But at some point, they did find their footing, and at least for right now, feeling that the status quo is okay. An economy, at least for right now, that does appear to still be running. Corporate profitability that still continues to seem to be growing. And all of this ahead, of course, one of the biggest earnings days that we've had in quite some time with NVIDIA, a potential make-or-break moment for public equity markets. On the screen there, you're looking at how we closed out the day, fractionally higher on the day. But that could change in a big way as we get NVIDIA earnings tomorrow, a PCE report on Friday, and then, of course, as we get into September, a very consequential Fed meeting and a lot of discussions here about what comes next. Joining us right now to talk about the market volatility is Alex Fitch. He's a partner and director of U.S. research at Harris Associates. Alex, great to have you here on the program. Volatility might sort of understate what has gone on over the last few weeks and months. Some of it, of course, driven by the political, but there's also been a lot of uncertainty about corporate fundamentals, about the strength of the AI trade, how much further that could continue going on, and the idea that market valuations, at least in public markets, by some metrics, do seem stretched. I am curious of your assessment right now of where we stand and whether you think there is maybe an argument to be made for further gains.
Yeah, thanks for having me. At Harris Oakmark, first, I just emphasize we are long-term value investors. We are buying businesses with the idea we're going to be owning them 5, 7, 10 years into the future. The really interesting thing to us about the market is just how bifurcated it's been. I mean, you have had so much of the market's return driven by this handful of companies, and you look at the S&P 500, you're up 50% over 4 years. You're trading at 25 times earnings. On the surface, looks very expensive. We're value investors, and the thing that's so compelling to us is that 1/3 of the companies in the S&P 500 today trade at 14 times earnings or less. And interestingly, that's actually exactly the same number as traded at 14 times earnings or lower back in August of 2017. So you've had this 8-year period where you've had incredible market returns. You've had a lot of growing concerns about the valuation of the overall market. And yet for value investors like us, the opportunity set is actually relatively similar. We're still able to build diverse portfolios of value stocks and actually finding ideas in new sectors.
Where are those value stocks right now? Because typically when we have these conversations about value, we're always kind of looking to small cap stocks and some of the economically sensitive sectors. And I've heard arguments against for sort of avoiding some of those areas. Where are you actually finding the value right now, Alex?
I think from a size perspective, the smaller the cap size, the more value we're finding today. I would say broadly speaking, there seems to be such little appetite from investors to have any exposure to businesses that have the slightest bit of headwind or even slowing growth. I think healthcare is a very good example. Over the last decade, we scarcely owned healthcare stocks at Harris Oakmark. We thought that they looked expensive. They were priced for their safety. 10 years later, though, healthcare has underperformed the S&P by 160 percentage points. And all of a sudden, you have some headwinds to various parts of the system. And we're starting to find opportunities there. I think the clinical research companies are a good example, IQVIA, Icon, Charles River. We own all of those names in the Oakmark Select Fund. They are companies that provide outsourced services for clinical trials. They are the critical cogs in the American R&D system and drug development. These were prized assets. They traded at a premium to the market. They have fast organic growth. They have high returns.
Yeah.
But as we've seen R&D slow post-COVID and their growth slow, now we can buy them at a 30 to 50% discount to the market.
Yeah.
That is the type of opportunity we're seeing today.
I want to get your thoughts on financials. This was actually kind of a story that kind of got buried amidst all the politics today. The KBW Bank Index, larger banks, if you will, closing at its highest level since 1992, basically since the inception of the index. And of course, this is an index that has lagged quite some time coming out of the financial crisis and really for the last couple of 2 or 3 years where you had the big rally in tech and everything else. What is attractive, in your view, right now about financial stocks, if at all?
Yeah, well, I think the banking sector, you went through a 15, 16-year period where regulations were a consistent headwind. And I don't think you've been in the better regulatory backdrop with tailwinds at your back for the banks since before the great financial crisis. And if you look back at that point in time, that was a point in time where bank stocks would trade at 80, 90% of the overall S&P 500 PE. Today, there are a lot of banks trading at 40, 50% of the overall market PE. But that regulatory headwind seems to be fading. And the market multiples might be high. The bank multiples aren't demanding.
All right, Alex, great stuff. Alex Fitch is a partner and director of U.S. research over at Harris Associates. And I do just want to reiterate kind of the big moves that we've seen really over the last few weeks and months in financial stocks with that KBW Bank Index closing at what is effectively a record high, basically since 1992, the inception of that index. Meanwhile, we turn back to the post-market trade here. We were keeping an eye on some of the apparel makers with outsized exposure to tariffs, PVH Corp., the owner of Tommy Hilfiger, and the Calvin Klein Bernstein brands actually rallying here in the post-market trade. The company did beat on some metrics, missed on a couple others, but then gave full-year guidance that did appear to appease investors. While it is taking some tariff costs, it says it can manage the rest. Meanwhile, keep an eye on the software space. Okta rallying about 3% here in the after-hours trade. The identity security company reporting a beat in a raised quarter, and MongoDB, the enterprise cloud software company, also getting a nice bid, up 23%. It was one of the big laggards earlier this year. Now finally starting to get its mojo back. A lot of optimism here about some of the spending that we continue to see in the tech space on hardware and, of course, AI. And, of course, that is the backdrop to a big earnings report less than 24 hours from now with NVIDIA. That conversation coming up next here after the break. This is Bloomberg. All right, it's hard to understate what's about to happen in about 24 hours. NVIDIA, the world's largest chip maker, is expected to report results. And of course, this has been the center of not just the AI trade, but really the entire trade in this market for the last couple of years. You take a look at the 3-month chart there on your screen, 34%, and that doesn't even tell the story. You go back to 2022, late 2022, and of course, the introduction of ChatGPT to the public, and NVIDIA has been on fire. If not the best performing stock, depending on the index, it's certainly in the top 5. But a lot of questions about where that AI spending is going and how much longer it can continue. Ben Axler is the founder and chief investment officer over at Spruce Point Capital Management. And he joins us here in Studio 2 to talk a little bit more about where the AI investment actually goes. Look, NVIDIA has attracted a lot of money, a lot of cash from investors because they're basically selling the one main thing everyone needs. But there are all these other companies that sort of just came up out of nowhere. Some changed their company to add .ai to it. Others that just basically said, we are an AI company. And they started raking in a lot of money, too. Does that continue?
I think we're now at the phase where the market's being a little bit more discerning, right? So early on, to your point, if you attach yourself to the AI trade, whether it's through having a ticker named AI or appending .ai to your name, you got that valuation boost and investors rallied. Now we're a couple years into the trade, right? And so the market's starting to discriminate more between those that are really getting the leverage and the growth that one would expect versus ones that are just not there.
How do you determine that, though? Because, I mean, you could look at NVIDIA. It's easy to see, right? You know how much chips they sell. You see the growth rate. For those companies where it's a little more squishy, how do you sort of separate the wheat from the chaff?
Yeah. For us, I mean, it all starts with the people, right? So we focus very much on management, and we like to see management that has a history of executing and not just promoting AI. So, you know, for us, we've had some good successes with a couple companies, C3 AI being one, Tempest AI another, where we find a history of those executives pivoting to the latest technology, promoting it, selling stock, and then ultimately, you know, the company's not performing up to expectations. And so for us, it all starts with management behind the AI trade.
For investments that you make, are you looking for companies that are making money by selling AI-related products or companies that are benefiting internally from the use of their own AI tools?
So I think it's both. You know, for those that are selling an AI solution, number one, we want to see that it delivers value, right? So we talk to people in the market, users, customers. We also evaluate partnerships that these companies promote that aren't always necessarily that great. You know, if you're a fledgling AI company and you claim to have a big partnership with a global company, that might sound nice, but may not necessarily deliver results.
Are there any parallels to kind of what we saw in the dot-com boom? Everyone keeps bringing up this anecdote how when we talk about the internet boom and all that happened, that at the time that frenzy was going on, Alphabet, or Google as it was called then, didn't even exist as a public company. And yet they are now, of course, at least up until a couple of years ago, basically the 800-pound gorilla when it comes to internet search.
Yeah, I mean, you know, there are some parallels between today and 20 years ago when I was starting my career. I think this time around, certainly in the tech trade, there's real earnings behind the Googles, the Amazons, the Facebooks. And we're seeing IPOs come public that are attaching themselves to the AI trade. And they're going up quickly, attracting a lot of retail, but then some hot airs coming up, but you're not seeing the overall market go down. And I think this time around, there's stronger earnings. Valuations are still high, but there's a broadening out of the shareholder base. We've seen much bigger retail participation this time around.
But you are a believer in some of the, I guess, the predictions about what AI can mean for us all. The idea that it would increase productivity or reshape our economy. Is that real or is that hype?
I think it's real. I just think it's going to take a little bit longer to play out. I mean, there have been some companies where companies have been introducing new products with AI features. But, you know, when you talk to some customers that use it, they say, yeah, it's incremental. It's not really a game changer, but it's now being sort of expected that companies are going to incorporate AI functions into their products. So it's incremental. Over the longer term, more revolutionary. But I think, you know, expectations, we believe, are a little high in the near term.
All right. You're going to have a watch party tomorrow for NVIDIA, or is that just kind of well beneath you?
I think all eyes on that, and I think expectations are high. They'll probably deliver.
Great to have you here. Ben Axler is the founder and chief investment officer of Spruce Point Capital Management. A lot of big things happening tomorrow. We're going to set you up for what to watch over the next 24. That's coming up after the break. This is Bloomberg. All right, here's what the markets are going to have their eyes on over the next 24 hours, a slew of earnings, and we start in the pre-market with a closer look at the state of the consumer. Kohl's, Williams-Sonoma, Abercrombie & Fitch all set to report earnings before the bell, and after the bell, we get more in that space from Guess, Five Below, and then, of course, we move to the tech space. Snowflake and CrowdStrike set to report, but NVIDIA, of course, is going to be the star of the show. The $4 trillion company set to tell investors whether that phenomenal growth rate that they've gotten used to can continue going forward, whether that CapEx spend and the dependency on just a handful of hyperscalers can continue to support the trade. When it comes to the macro and economic front, keep an eye on mortgage applications. The weekly numbers coming out at 7 a.m. tomorrow. And don't forget, tariffs set to take effect on India, and it is big. 50% U.S. tariffs on India set to go into effect. That does it for us here on The Close. Balance of Power is next.